Hi everybody, my name's Griffin Bridgers. This is part 5 of the basics of the portability election. Today we're going to dive into valuation issues when it comes time to calculate the unused exclusion and how that can carry over to the subsequent use of that unused exclusion. Before we get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, this is a continuation of an ongoing series where we've discussed the portability election. We've gone through 4 parts so far, the most recent being the basics behind making the election on IRS Form 706. And today is going to be a natural outflow of that prior discussion when it comes to how we report the value of assets that might generate this unused exclusion on Form 706 and what boxes specifically we have to check if we want to have what we're going to come to know as a pared down 706 portability return that might estimate values of certain assets. Now, before we get into the fun part, which is having a pared down return, it helps to kind of know some of the inside baseball behind this, not necessarily to scare you, but to say that this may not always be a good idea, and that no matter what you do from a valuation perspective, you may not be out of the woods simply by filing a portability return, because the purpose behind filing any transfer tax return, typically a 706 or 709, is to lock the IRS into accepting the values that you report on that return, because most of the homework and heavy lifting that goes into these returns involves the substantiation of the value of assets, especially illiquid assets, using appraisals or other methods that might be mandated by the tax code. So, as long as you do that and go through the exercise of describing and reporting things in the way the IRS requires and providing adequate disclosure of the asset and its value, then typically you'll get a 3-year limitations period, which means the IRS has 3 years to come back and challenge the value of that asset or forever hold its peace. Now, as we're going to see, that changes with portability returns, but the incentive here is for the IRS to look at that value and usually try to increase it, because an increase will mean an increase in tax either immediately or potentially an increase at some point in the future by the use of more applicable credit. But because the unused exclusion is based on the values of assets that are reported, especially when not all of the assets generate that exclusion, there is more potential for gamesmanship that the IRS sees, and when that exclusion can relate to a return that might not be reported for a long time, the IRS has more incentive to go back. Now, what do we mean by it might not be reported for a long time? Well, remember, the deceased spouse's unused exclusion, the DSUE, can then be applied by the surviving spouse as an applicable credit against both gift tax on lifetime gifts and ultimately estate tax on the surviving spouse's taxable estate. So value really has 2 effects here. 1 is the calculation of the DSUE itself, and 2 is the value of the assets to which the DSUE is applied. When it comes to point 2, we're going to follow the normal rules. Nothing really changes there other than an increase in the applicable credit that the surviving spouse might have. However, when it comes to the calculation of the DSUE itself, we're going to find out that limitation period becomes very open-ended, because this has a downstream tax effect. So what the IRS says under the regulations is we have, as long as that DSUE is used, this unlimited limitations period to go back and review the calculation of the DSUE itself. Most often, their incentive and their goal there would be to decrease the DSUE available to the surviving spouse. So, for example, that 3-year limitations period doesn't apply here for the DSUE purposes itself. If we had a decedent who died in 2011, let's say, and then the surviving spouse used a DSUE that was left from that decedent 12 years later in 2023, I'm talking about the use, not when it was received in 2011, But if that use of the DSUE preserved in 2011 occurred 12 years later, the IRS could still go back and challenge the decedent's 2011 706 under which that DSUE was preserved. So really what this would be probably would be a challenge to the values of assets reported by the decedent on that 2011 706. Now I want to note that this open and unlimited limitations period doesn't apply for any purpose other than the DSUE. So for example, if the challenge to values that reduce the DSUE, let's say, had the effect of increasing the estate tax that should have been paid in 2011, we still have the same 3-year limitations period typically on that additional tax. So if the IRS were to go this route, they couldn't go back and collect that additional tax from the decedent's estate unless they could show for some other purpose, maybe a substantial valuation understatement or something like that, that the limitations period had been kept open longer. And typically you'd only see that in very egregious, negligent, or fraudulent situations that you'd actually have that still open 12 years later for the collection of additional tax. But big lesson here is really that for purposes of the DSUE amount, that limitations period is always open until the DSUE is used or goes away. So with that being said, there's a special valuation rule that comes into the use of the DSUE, which ironically ties into that unlimited limitations period and may or may not affect it, or may or may not affect the incentives of the IRS to go back and challenge values. Now, to claim the DSUE to make a portability election typically requires a fully completed estate tax return. But if your sole purpose for filing is to make the portability election and you're not otherwise required to file, it can be pretty burdensome to have to go through and substantiate all asset values on the 706. Luckily, if you're only making a portability election and you're not otherwise required to file, there is a special rule under the Treasury regulations which allows the executor to elect to estimate the values of certain assets that generate the DSUE, so long as they're adequately disclosed by description on the various Form 706 schedules. Now, one quick point I want to note is that estimating those values probably couldn't be relied upon to determine basis under Code Section 1014b9, because, especially as we're going to see later, we're not necessarily estimating each asset's value. Really what we're doing is taking a blanket estimate of total values rounded up by increments of $250,000. So while this seems to create a nice streamlined option here, especially if everything generates a DSUE, it's not quite as relaxing as it seems. The executor still has to use quote-unquote due diligence to determine the quote-unquote best estimate of values, and the regulations go on to say that this is done under penalties of perjury. So the executor still can't pull numbers out of thin air. They still might have to go through the exercise of getting a valuation and possibly spending the money to do so. So given that standard, a lot of executors may not necessarily be incentivized to use this alternate method over the more traditional method if the difference in liability is not much or not significant at the end of the day. But assuming you had an executor who wanted to make this election, what they do first is go to the top of the 706, Part 1, and we'll see on line 11 here in the red box that if you want to estimate the value of assets included in the gross estate, then that box has to be checked. If you check that box, you can estimate values, but you don't necessarily have to. And checking that box isn't enough. We then have to look at which assets actually qualify for this special valuation rule. So remember I mentioned this general rule that the assets have to generate the DSUE? Well, the way they do that is by reducing the taxable estate. So typically the assets that defer estate tax and generate DSUE are going to be the ones that qualify for the marital and charitable deductions. So if you have any assets, for example, on the return that go to a non-spouse under the estate plan, or maybe to a credit shelter trust, you can't estimate the value of those. A better way to think of that is that any asset that uses the decedent's exclusion doesn't apply or doesn't qualify for this special valuation rule. It's only those that defer estate tax and generate unused exclusion in that regard, typically through the marital or charitable deductions. Now, even if it creates a marital or charitable deduction, that's not enough. We have to dig into how it does and what rights the trustee has, maybe under a trust or something like that, or maybe an executor has under the will. And the most significant issue here is that fractional interests in property, which do not fully qualify for the marital or charitable deductions, may not qualify for this special valuation rule either. So if you have, for example, an instrument that funds a marital trust using a fractional formula where part of the asset goes to a marital trust and maybe the other part goes to a credit shelter trust, or similarly, if you have a partial Q-tip election that applies to fractional interests, then those fractional interests don't qualify for this estimate and value, which is somewhat of a relief because technically fractional interests could, in that regard, generate discounts here, which would be difficult to calculate to begin with. But at the same time, it helps to really look at this in the context that you can only apply this to whole assets that qualify for the marital or charitable deductions. Also, there are some other tax elections downstream that can be affected not just by specific assets, but also by the value of maybe the adjusted gross estate in full. For example, if you wanted to claim a special use valuation, or if you wanted to make the Section 6166 election to pay estate taxes in installments, or even in a non-estate tax situation, if you wanted to make a Code Section 303 stock redemption, those elections may create a situation where you can't use the estimate of value. So if there's any other tax code provision that relies on the estate tax value as finally determined, you don't get the benefit of this estimate in value, as long as those assets may not even necessarily directly lead to one of these types of elections, but affect the value of the gross estate for purposes of determining those types of elections. So, that being said, as I mentioned, if we're estimating values, we first have to figure out the pool of everything that actually qualifies, and then we're not going to estimate the value one by one through those whole non-fractional assets. Instead, what we're going to do is estimate the value of everything in increments of $250,000 rounded up by the executor, which is really why this estimate cannot establish basis, because we're not reporting individual asset values. We're reporting a blanket estimate in $250,000 increments for everything that might qualify. Now, it's important to note that these values don't end up on the various schedules on which you report value property, but instead are derivative and carry over to Part 5, lines 10 for the gross estate, and then line 23 for the deductions. And because these are values that are estimated for property that should qualify for the marital or charitable deduction in full, based on the fact that it generates a DSUE, then really the values on lines 10 and 23 should end up netting out at the end of the day. So where do we see this? Well, if we go down a few pages in Form 706 to Part 5, a recapitulation, we see first on the gross estate calculation, line 10, where we have the estimated value of all assets subject to that special rule under the regulations, and that's where we'd put in a value that has to be an increment of $250,000. And then from there, we would net that out in the estate tax calculation by also entering on line 23 here. On the next part of this Part 5, lines 14 through 24, we'd go to line 23 specifically, where we deduct that, again, increment of $250,000 estimate of those qualifying assets. And then that carries over to the calculation of the gross estate, the taxable estate, and the DSUE. But again, keep in mind that this only applies on an estate tax return that is being filed for portability purposes only, and does not apply in a situation where you're actually required to file a return because your gross estate and adjusted taxable gifts exceed the basic exclusion. So you only qualify for this special valuation rule if your gross estate and adjusted taxable gifts, when added up, don't exceed your basic exclusion amount. Now, this is as close as you're going to get in 706 land to a pared down return. There's often a question on whether you can have a pared down or partial return for purposes of perhaps making a Q-tip election or allocating GST exemption, and you can't. This is really the only way you can get a pared down return, and it might be that you could piggyback the Q-tip and GST and everything off that, but at the same time, as we're going to later see, the utility just isn't there for those types of returns. Instead, this utility is going to come in for plans where most or all of the assets qualify for the marital deduction, and you're making a Q-tip election for everything, because as we're going to see, because marital or charitable deductions generate DSUE, it's going to be important here to increase your Q-tip election because that's going to increase the DSUE that might be generated. And keep in mind, too, that post-mortem activities, such as a partial Q-tip election or a Clayton Q-tip election, or even a disclaimer of partial interests in assets, could affect your ability to use this pared down 706 through that special valuation rule because, again, assets that only fractionally qualify for the marital or charitable deduction won't qualify for that special valuation rule. So especially look at those post-mortem elections and also the terms of the trust or the will, whether those require fractional funding between various trusts or the trustee actually elects fractional funding. Those fractional funding formulas could affect your ability to use this at the end of the day anyway, maybe in full or in part. Also, keep in mind, too, that this special valuation rule is typically going to underestimate the DSUE, so you're going to end up with not necessarily an accurate amount of what you can use. And this special valuation isn't going to apply to the actual use of the DSUE by the surviving spouse. So when they file a 706 or 709 to apply the DSUE as applicable credit, you're still going to have to report asset values in full. So what's coming next? We have the application on Form 709 of the DSUE. Then we'll get into more of the theoretical and practical pieces behind planning at a 30,000-foot view. How does a portability election stack up in the holistic tax view compared to the AB planning methods, estate equalization, and also basis planning? Again, how does the Q-tip election factor in? And importantly, we'll look at qualifications behind whether the surviving spouse has to be a U.S. citizen and how that might limit the application of the DSUE. As always, if you're a tax or estate planning practitioner and you have any questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com or fill out the link in the notes below to go to a form that allows you to suggest topics as well. But please note that I cannot give tax or legal advice in response to your questions. If you enjoy this or any other series or content I have, and you'd like that content as a topic at your upcoming estate planning council, FPA chapter, bar association, CLE program, so have it, feel free to reach out as well. I'm happy to be a speaker if you have the programming need. But thank you again for listening, and I look forward to seeing you in my future content.